I mean, if I say the name HP, let's be honest about what flashes into your mind right now. You were probably thinking of the year 1998 or something.
Yeah, like a beige humming tower sitting under a desk.
Exactly, in some beige cubicle. Or maybe you're having this visceral memory of a home printer that was chronically, mysteriously out of cyan ink right when you needed to print a boarding pass.
Right, the absolute worst timing, always.
Always. It is a brand that a massive portion of the market has completely written off as just a technological dinosaur, like a total relic of the past. But here's the 30-second hook for you for this deep dive. What if I told you that very same dinosaur is quietly, methodically building a high-margin, utterly dominant AI empire right under our noses?
It really is the ultimate corporate plot twist, you know? You think you know exactly how the story ends, and then the protagonist completely flips the script in the third act.
Yeah, and the tension in that plot twist is the central mission for our deep dive today. We're putting HP under the microscope. We really need to figure out if this company is a deeply discounted turnaround story, offering a massive opportunity if you're paying attention, or if it is just a classic, dangerous value trap hiding a structural, inevitable decline.
Right, and to set the stage for you here, we are looking at a fundamental contrast that is defining HP right this very minute. On one hand, the broader market is treating the stock like a business that is already in hospice care.
Oh, definitely.
I mean, it is trading at a deeply compressed trailing price-to-earnings ratio, a PE of just 8.07. And for context, in the tech sector, that is absolute basement-level valuation.
Yeah, but I know what he wants it.
Exactly. But on the other hand, if you look at our sources and their most recent internal metrics, there is a sudden, very sharp operational rebound happening. And it is entirely fueled by the artificial intelligence wave.
Okay, let's unpack this, because we need to move past the broad, generic narrative of AI is the future and actually look at the cold, hard cash hitting the balance sheet right there.
Yeah, the numbers are wild.
The actual financial numbers proving this hardware rebound are staggering. So in the second quarter of fiscal year 2026, HP's revenue hit $14.4 billion.
Yeah.
That is almost a 9% year-over-year increase, and it absolutely crushed the consensus estimate of $13.99 billion.
And importantly, it wasn't just top-line revenue inflating. Their adjusted earnings per share, the EPS, came in at 86 cents for the quarter.
Well, Wall Street had only projected 71 cents, right?
Right, exactly. That is a massive, undeniable beat. In fact, it gave management so much confidence that they actually narrowed their full-year FY26 EPS guidance to a very healthy $2.90 to $3.10 range. The personal systems segment alone, which is basically their core PC business, surged 13% year over year to $10.2 billion.
But here is the fascinating twist, the piece of data that really made me stop and reread the sources we were looking at. Total PC unit volumes actually declined by 7% year over year. They physically sold fewer computers.
Yep, fewer boxes out the door.
So if you're looking at your portfolio, you have to wonder, how on earth is revenue up nearly 9% when unit sales are down 7%? Well, the answer lies in the average selling price, or the ASP. Their ASPs exploded by 22.3% in a single year.
Right, because AI-capable PCs now make up an astonishing 44% of HP's total unit shipments. It is a complete and total shift in the fundamental unit economics of what they are boxing up and shipping out.
Right, it's like a car dealership. Imagine a local dealership that actually sells fewer cars overall this year compared to last year. But instead of selling $30,000 economy sedans, they've managed to completely transition their entire customer base to exclusively buying $100,000 luxury SUVs.
So overall revenue skyrockets, even though the parking lot is moving way less metal.
Exactly. But I want to push back on this because it sounds a little too good to be true. Is this 44% AI mix actually a sign of sustainable consumer demand? Or is HP just aggressively stuffing the retail channel with premium, expensive products to inflate these early numbers and look good for Wall Street?
Well, what's fascinating here is that this isn't just about sticking a shiny new AI sticker on a slightly faster laptop to justify a markup. It is about a fundamental structural shift in what a computer actually needs to do in a modern office. And HP is perfectly positioned to ride a massive macroeconomic wave, which is the end of support for Windows 10.
Ah, right, the forced upgrade cycle.
Exactly. When Microsoft ends support for an operating system, it's not a suggestion, it's an ultimatum for enterprise clients. Think about massive corporations, global global banks or a regional hospital network.
They can't just run unsecured software.
Right, an IT director at a hospital cannot just run outdated unsecured software. They are effectively forced to undergo a broader PC refresh cycle to maintain strict security compliance. So they have to replace 10,000 laptops anyway.
And why choose the AI-enabled ones specifically?
Because processing sensitive data, like patient records or financial models, locally on the physical device using an AI chip, rather than sending it back and forth to the cloud, is infinitely more secure and significantly faster with zero latency.
Okay, that makes perfect sense.
Yeah, that local processing power and elevated security is exactly why an IT department is more than willing to pay that 22% premium. Management is even forecasting that these AI-enabled PCs will make up 60 to 70% of total unit shipments within the next year. So it is not channel stuffing at all. It is a perfectly timed enterprise upgrade cycle colliding with a completely new technological standard.
Okay, so if they're successfully selling these high-margin AI machines, and the enterprise demand is legitimate, we have to look at how they're differentiating themselves. The market is incredibly crowded. I mean, every tech CEO on Earth is currently trying to sell you an AI computer.
Oh, absolutely. Everyone has an AI pitch right now.
So how is HP actually building a competitive moat around this new revenue stream?
Well, in the technology hardware space, building a genuine moat is notoriously difficult. Physical components get commoditized incredibly quickly. A processor is just a processor.
Right.
But HP is leveraging something that takes decades and billions of dollars to build, which is massive, entrenched global distribution scale. They operate seamlessly in 180 countries. They have deep legacy relationships with enterprise procurement departments all over the world.
I see that, but let me challenge that premise for a second.
Right.
Anyone can buy a high-end chip and screw it into a sleek metal chassis, right?
Yeah.
What stops Dell, Lenovo, or any other competitor from eating HP's lunch tomorrow? Are they actually building a moat, or are they entirely reliant on the underlying tech of their partners?
That is the big question.
Because our sources detail this massive strategic partnership with OpenAI to co-develop AI agents, specifically for customer support and internal operations. And on the hardware side, they've launched the Omnibook laptops, equipped with NVIDIA RTX Spark technology, targeted directly at AI professionals and creators. So isn't HP just selling a generic metal box that houses NVIDIA and OpenAI's actual genius?
It is a totally valid question, and it's the core of the hardware debate, really. But this is where we have to fundamentally reframe how we think about a moat in enterprise technology. Distribution is the moat.
Okay, explain that.
Think about it from OpenAI or NVIDIA's perspective. You have developed world-changing software and mind-bendingly fast silicon. But how do you actually physically deploy that onto 10,000 desks in a multinational bank located across 12 different time zones?
Oh, because software does not just magically install itself securely on a massive corporate network?
Precisely. You need a reliable, globally entrenched supply chain to actually reach the enterprise customer at scale. HP is perfectly positioned to be that physical bridge.
So the hardware is just the delivery mechanism.
Exactly. And they aren't just putting in generic chips either. That NVIDIA RTX Spark integration you mentioned is crucial.
Right, for the creators and professionals.
Yeah, RTX Spark is an incredibly high-performance professional tier of hardware. It allows data scientists and 3D creators to run massive AI models locally without the system crashing. By targeting that high-end professional tier, HP commands the absolute highest premiums.
And there are some incredibly intriguing, unconfirmed rumors floating around the market right now that take this physical bridge concept a step further.
Yeah, the workstation rumors.
Exactly. The chatter suggests HP might use this deep NVIDIA integration to aggressively steal market share in the dedicated AI workstation space, which is a niche usually dominated by much smaller, much higher-priced boutique competitors.
Right, which would be huge for their margins.
And furthermore, there is intense speculation that the OpenAI partnership could evolve far beyond just internal customer service tools. The rumor is that HP might eventually bundle consumer-facing OpenAI software subscriptions directly with HP hardware right out of the box.
And if they start bundling software subscriptions at the point of sale, that completely changes the financial reality of the company. You move from a one-time hardware sale to a recurring, high-margin software revenue model.
Which brings us to the most critical part of understanding any corporate turnaround, analyzing the actual financial health. We've established this incredibly compelling AI growth narrative, but we have to verify if the underlying cash flow and the actions of the people running the company actually support this optimism.
We definitely have to follow the money.
Here's where it gets really interesting, because when you look under the hood at the balance sheet, it initially looks like a bit of a mixed bag. The balance sheet definitely carries some heavy scars from operating in a mature, somewhat stagnant PC market for the last decade.
Yeah, it's not perfectly pristine.
Right. On paper, they actually have a negative stockholders' equity of negative $144 million. But, and this is a massive foundational but, their cash generation has violently inflected in a positive direction.
It really has. Free cash flow swung from a negative $100 million in Q2 of the prior year to an incredibly robust $800 million in Q2 of FY26.
That swing is huge.
That swing in free cash flow is the absolute engine of this turnaround. Let's explain why that matters more than the scary-sounding equity number. Negative equity sounds alarming to a retail investor, sure.
Yeah, it sounds like they're going broke.
Right, but in mature tech companies, it is often just the accounting result of years of aggressive stock buybacks and heavy dividend payments exceeding retained earnings on a ledger. What actually matters for a company trying to pivot its entire business model is the actual cash coming in the door today.
And generating $800 million in free cash flow in a single 90-day period gives management tremendous operational optionality. And they are certainly not hoarding that cash either. They are putting it to work. They are currently supporting a 30-cent quarterly dividend, which yields over 4% for shareholders right now.
Which is a very solid yield.
Yeah. They are also executing $100 million in targeted stock buybacks to reduce the float. And simultaneously, they have rolled out a major aggressive restructuring plan. They are cutting 4,000 to 6,000 jobs globally to deliver roughly $1 billion in run rate savings by FY 2028.
It is a textbook ruthless efficiency drive. They are aggressively trimming the legacy fat from the old business while actively funneling all that freed up cash into shareholder returns and the new AI hardware initiatives.
But let's pause and look at the human costs and the optics of this pivot for a second, because it is stark.
Yeah.
They are laying off up to 6,000 people. Real people losing their livelihoods in a tough economy.
Yeah, it's never easy.
Yet, at the exact same time, executives are executing $100 million in buybacks, paying out 4% yields, and according to SqueezeWatch data, corporate insiders are heavily buying up the stock. Over the last 90 days, insiders bought a net 141,676 shares.
That is a huge signal.
That was across 14 separate buy transactions versus just one single sell transaction. If you were watching this company from the outside, you have to ask yourself, is this a sign of a genuinely healthy long-term turnaround? Or is this just executives executing ruthless financial engineering to squeeze the last drops of value out of a legacy brand while protecting their own wealth?
It is a very fair critique, and it highlights the painful tension you see in almost every major corporate restructuring. But if we evaluate this purely on the mechanics of the market and insider behavior, it really comes down to asymmetric upside and personal conviction.
How so?
Think about how insiders get paid. Executives receive massive amounts of stock-based compensation, so they generally do not need to go into the open market and buy shares with their own after-tax cash.
Unless they think it's cheap.
Unless they strongly believe the stock is deeply, fundamentally undervalued and they want to personally capitalize on an impending upward correction. A 14-to-1 buy-to-sell ratio is a screaming signal of internal confidence.
Right. If the ship was truly sinking, they would be quietly selling, not buying.
Exactly. And remember that trailing PE of 8 we discussed earlier? With a price-to-sales ratio of just 0.35, the broader market is already mathematically pricing in a worst-case scenario. It's pricing in total stagnation.
So there's almost nowhere to go but up if they execute.
Right. So when you see that massive insider buying alongside a $1 billion cost-cutting plan and the very real AI supercycle pushing those ASPs up 22%, it suggests management isn't just engineering a short-term pop. They're putting their own personal wealth on the line because they see the operational pivot working behind the scenes much faster than Wall Street realizes.
Okay, that logic tracks. The market expects them to fail, so any sign of genuine operational life is going to be disproportionately rewarded. But to keep this deep dive entirely balanced, we cannot just rely on insider optimism. We have to pivot and stare directly at the very real structural threats that could completely break this investment thesis.
We definitely do. We have to look at the bear case.
Right. What are the active threats that could derail this entire turnaround?
Well, the most glaring anchor physically weighing HP down is the legacy printing segment. It is a massive structural drag on the entire enterprise. Consumer printing alone dropped 10% in the last data release.
Wow.
The reality is simple. People just are not printing documents at home the way they used to 10 or 15 years ago. The enterprise printing side still has a pulse, sure, but the consumer side is in systemic decline.
So you have this high-growth AI PC business constantly fighting against the gravitational pull of a dying printer business. But as heavy as that anchor is, the printing decline isn't even the biggest, most immediate threat to their margins right now, is it?
No, actually it isn't. The primary existential threat to this turnaround is severe margin compression due to rapidly rising memory costs. The sources indicate we are looking at a 15 to 18% increase in broader PC component costs right now across the entire industry.
Wait, let's explain the mechanics of that. Why are memory costs suddenly spiking by almost 20%?
It all comes down to supply and demand in the broader AI ecosystem. To build these incredibly powerful AI PCs, you need massive amounts of specialized high-bandwidth memory. But guess who else desperately needs that exact same memory right now?
Data centers.
Exactly. Every single major data center on Earth is currently building out massive server farms to train AI models. That insatiable global demand is creating a severe supply crunch for RAM. HP doesn't manufacture the memory, they have to buy it on the open market.
And they're being forced to absorb that 15 to 18% cost increase.
Right, which translates directly to a projected 30-cent EPS headwind for FY 2026.
A 30-cent penalty on earnings, just because the internal parts cost more to acquire. That is a massive hit to the bottom line. And this margin threat isn't a closely guarded secret either.
Not at all.
It is exactly why heavy hitters like Goldman Sachs recently reaffirmed a strict sell recommendation on HP, slapping a $19 price target on the stock, which is well below its current trading levels. Furthermore, if you look at the upcoming Q3 FY26 earnings, management itself has guided for a year-over-year decline.
Yeah, they are actively projecting EPS to drop from 75 cents down to a range of 47 to 63 cents.
So if you are an investor looking at this, I have to pose a question. Knowing that global component costs are aggressively eating into these fancy new AI legends, and seeing institutions like Goldman Sachs explicitly warning you to sell, does a 4% dividend yield actually compensate you for taking on that level of execution risk?
Well, if we connect this to the bigger picture, we find the absolute core of the deep value investing argument. Those risks you just laid out, the spiking memory costs, the systemic printer decline, the Goldman downgrade, that is exactly why you have the opportunity to buy a tech giant generating $800 million in free cash flow for a PE of 8.
Ah, so it's already baked into the price.
The risks are entirely priced in. The entire thesis hinges on the AI premium. If the 22% average selling price premium that HP is getting for these enterprise AI PCs holds up against those rising memory costs, and if they successfully execute that $1 billion in overhead cuts by 2028, the stock will mathematically be forced to rapidly re-rate upward. The bar for them to beat expectations in Q3 is set incredibly low.
So what does this all mean for you as a listener? Let's pull all of these threads together. HP is essentially caught in a high-stakes, multi-billion-dollar corporate tug-of-war right now.
That's a great way to put it.
On one side of the rope, you have a dying consumer printer business and soaring global memory costs actively dragging their earnings down. On the other side of the rope, you have a booming, high-margin AI PC product mix, a massive forced enterprise upgrade cycle, and a group of corporate insiders buying up shares with their own money like there is no tomorrow.
It is the absolute definition of a transitional moment. The old HP is fading away, and the new HP is fighting tooth and nail to take its place.
It's a fascinating standoff. And as we wrap up this deep dive, we want to leave you with something to really mull over as you watch this company navigate the next year. We talked earlier about those unconfirmed rumors regarding software bundling and the intense pressure memory costs are putting on the physical hardware.
Right, and this raises an important question, perhaps the most important question for the entire sector moving forward. I'll leave you with this final, somewhat radical thought to ponder.
Okay, let's hear it.
If memory costs and supply chain crunches keep aggressively squeezing hardware margins, what is the future of a legacy giant like HP isn't actually making money on selling laptops at all?
Wait, really? Not making money on the hardware?
Think about it. What if, driven by these massive partnerships with companies like OpenAI, the physical computer eventually becomes a loss leader, essentially given away for free or at cost? Instead of buying a metal box for a one-time profit, you pay a recurring monthly subscription fee just to lease the physical portal to your AI ecosystem.
Oh, wow.
It would instantly turn a legacy hardware manufacturer into a pure, high-margin AI utility company. It is a complete paradigm shift, and it would change the entire tech industry overnight.
A hardware company that doesn't care about hardware profits. That is a wild, brilliant concept to watch out for. Thank you for joining us on this deep dive. Until next time, keep digging into the data.